Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, will provide you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Good afternoon and welcome back to Real Estate 360, your number one source for all your real estate needs here in the Bay Area, where we provide you with the information you need to make the best fact-based decisions. Remember, Real Estate 360 is on 5 days a week at 3 p.m. and with a different host on different days, sharing our different perspectives of experience. I'm on your Wednesday host weekly, and I'm glad to chat with you today about something very important, I think, in the whole area of real estate investing, and that is how do you select the best place to invest in. So we will review, we went at some length on that last week, and I'm going to review some of that and continue, and we'll give you the whole A to Z input on the different aspects that make and your decision on Metro the right one. We will chat a little bit about the news regarding real estate, what's going on in the marketplace out there. We'll chat a little bit about that. And then at the end of the program, I'll give you my top tip for the day. So let's start off by looking at what the Federal Open Market Committee shared with us on their latest meeting. This is the committee that's sanctioned by, made up by the Fed, and they met recently and they changed their tune a little bit about how they're going to help our economy. First of all, their statutory mandate is for the committee to seek to foster maximum employment and price stability. The committee remains concerned that without sufficient policy accommodation, that means intervention, economic growth might not be strong enough to generate sustained involvement or improvement in labor market conditions. To support a stronger economic recovery and to help ensure that inflation over time is most consistent with its dual mandate, the committee will continue purchasing additional agency mortgage-backed securities at a pace of $40 billion per month. Yes, you've heard that right, and I'm sure you've heard that before. In the past, they picked specific amounts to purchase, and then that was it. So after they did that a number of times over the last 4 years, they said, well, rather than keep going back asking for more, we'll just get approval now to just do it on a monthly basis. So that's $40 billion a month. And that's not all. The committee will also purchase longer-term Treasury securities after its program to extend the average maturity of its holdings of Treasury securities at a pace of $45 billion per month. So that's on top of the $40 billion of the mortgage-backed securities. So that is that's quite a bit of stimulation that is continuing. So if you have any question about whether or not the government is done and letting the free market go at its own pace, think again. That's a lot of money that's continuing to be generated and printed to try to help this economy recover. The committee decided to keep the target range for its federal funds rate at 0 to 0.25% and currently anticipates that this exceptionally low range for the federal funds rate will be appropriate for at least as long as the unemployment rate remains above 6.5%. So 6.5%. I don't think there are many of us that think we're going to get to that point very quickly. So I believe that interprets to quite a long time we're going to keep this federal funds rate low. And inflation between 1 and 2 years ahead is projected to be no more than half a percentage point above the committee's 2% long-run goal. The longer-term inflation expectations continue to be well anchored. So that's still a lot of stimulus money that's going out, and now they're tying it to the when they will end it based upon what unemployment rate is going to be in the future and at what the inflation is. So as long as inflation stays about where it is, and as long as unemployment stays above 6.5%, we're continuing to pump about $80 billion a month into the economy. So we could have a whole program on the pros and cons of that, but at least you should know that there's that influence on the market, and we are anything but a free market. That's for sure. So let's now go and talk about how to pick the best metro to invest in. For all of us investors, traditionally we generally thought that the best thing to do was to go invest in your neighborhood or where you can drive to. But most people who are experienced investors now know that you invest where the return on investment is the best, just like you do a stock, as long as you have confidence in management, just like a stock. So if you have confidence in the management and you want to invest, use real estate as a vehicle, picking the best metro is very important, and it's often anything but your backyard, especially if you're in a high-end area. So let's review what we talked about last week, and for those that were not tuned in, we'll bring you back up to speed. First of all, the most important factor in determining whether or not a product or property will cash flow is the rent ratio. And the rent ratio is the monthly rent divided by the total investment into a property. So if you're buying a raw property and have to fix it up, the number you need is the total amount that you've spent once the rent is first rent check is in the bank, and not before. So that's that's quite important. So an example would be $100,000 home, rents for $1,000, $1,000 divided by 100K. That's 1% per month of the value of the home, and we look at that and call that a 1% rent ratio. And generally it is considered that in order for a property to be a good cash flow property with 20% down or 25% down, you have to have a 1% rent ratio or greater. And so why is that important? Does it really make that much difference from city to city? Well, it turns out it makes a tremendous amount of difference. That as you go across the country, you'll find rent ratios from 0.18 to 1.92. And that's hard to comprehend if you haven't been exposed to it before, but it really is. And when I was going from the high-tech world of managing companies in Silicon Valley to full-time real estate investing, I was quite shocked to see that there was that much variation from city to city. And when I spent about a year studying the different cities and different places to invest in to pick my target city, and by the way, I recommend if you don't have a large portfolio, don't go buy 12 properties in 9 different cities. It's too tough to manage. Pick 1 or 2 cities and focus on that until you've built up some portfolio. It makes the management of it much, much easier. But you'll find that Dallas and Dallas-Fort Worth area, San Antonio, and Houston have the highest rent ratios in the United States for major economic centers. The only major metropolitan area that's higher is Detroit, but you have to take on the risk of a generally declining economy and declining population. So let's look at the practical numbers. That how does this translate to money in your pocket? Well, let's say you have $600,000 that you want to purchase of real estate. You could buy one median price house in, say, San Jose, in the heart of Silicon Valley, and get about $2,000 a month rent. That's $2,000 divided by 600,000, or 0.33% rent ratio. Or you could take that $600,000 and buy 6 $100,000 homes in Dallas-Fort Worth area, those homes would rent for $1,000 a month apiece, or a little more actually, and you get $6,000. So for the same amount of property assets, you could get $2,000 in one city or $6,000 in the other city of total rent per month. It's pretty amazing, isn't it? That's triple one city to another. So that's why it's very important to pick a metro. Now, why hasn't everybody known this all along? Well, it turns out 40, 50 years ago, there was not that much difference. But as time has gone on, and we've had coastal cities that people move to because it's desirable from a standard of living or climate. It has driven up prices on the coast in certain cities much more than it has others. And with time, or with prices as they go up, the rents never go up in proportion to the price or value of the home. So the higher the home price gets, the harder it is to maintain that 1% magic rule of thumb ratio that you need in order for it to cash flow. So I hope that makes sense. And by the way, at any time you have questions about real estate investing, I'm be very glad to field them. I enjoy assisting other investors and sharing what I've learned. And TomWilsonProperties.com. Go there and you can email me, and I'll be glad to respond. So now you know about rent ratio and how much it can vary from city to city, and therefore, in order to get best cash flow, you've got to have the maximum income relative to the price of the home. And in a simple world, the cash flow is the income minus expenses. And in an ideal world, that's all you need to know. But in actuality, we do not attain the ideal situation, and our objective is to get as close to that ideal total possible income, and as close to the minimum expenses as we possibly can. So we're going to come back in a moment and look at what are those factors that are income and expense spoilers, those items that do not allow us to attain that ideal perfect income and minimum expenses. So we'll discuss that as soon as we come back. Stick with us, and this is Tom Wilson on KDOW 1220, the Wall Street Business Network.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Okay, welcome back. KDOW 1220, Wall Street Business Network. And we're discussing today on Real Estate 360, we're discussing how to select the best metro for investing in. Very, very critical, fundamental item, which it's amazing how many people do not really do their research. They just listen to someone that says, "Oh, I invested over here," and they go check it out. It seems okay. Don't do that. Go do your homework. Get inputs from several people. Look at how different cities compare to each other. Look at the different parameters that I'm presenting to you, and do your research and pick the best city, not just one that's okay. So we're talking about income expense. In an ideal world, you just pick the metro that has the highest rent and the relative to the purchase price, and assume that you're going to get all of that rent coming in, and there's not going to be any surprises on expense, and you're done. But unfortunately, it's not quite that easy. There are income and expense spoilers that detract from that ideal formula. So on the income side, let's look. What are some of the things that can detract from that income that you're expecting? One, certainly the vacancy. How much of the time is there no one there paying the rent? Collections. Maybe they're living there, but your property manager can't get them to pay the rent because they're under hard times. It's in an area that has economic difficulties. There aren't enough jobs. They picked the wrong tenant, so forth. So there are lots of reasons why someone could be there, and you've got a physical occupancy, but what really counts is your financial occupancy, right? How much money you get per year out of the total amount that you should be getting. So we refer to that as the financial occupancy. And then turnover rate. So that affects the vacancy. So if someone leaves early and it takes 3 months to get the place rented up because it's not a strong economic city, then all of a sudden that income that was expected is not there. Let's look on the expense side. What are some things that spoil the normal or add to the normal expenses? And what are those normal expenses? It's first of all, the mortgage payment. That's top. That's number one. That's the most expensive payment, or expense, the highest expense. And that is when we usually look at that, and when we're comparing examples as a typical investor 75 or 80% loan. The next most important or highest is usually the taxes. Third is property management, and then insurance, and then repairs. So those are quite predictable unless you have surprises. And what are those surprises? One certainly is maintenance, either because the tenant did not take good care of it, or two, because the product and property was not very good in the first place, and therefore there's a lot of deferred maintenance that you have to keep going in and fixing. And if you have high turnover, then you've got advertising and lease-up fees and so forth. So all of these can really affect your bottom line. For example, if you have a net income of, say, $250 a month, or about $3,000 a year, which is not uncommon for a good quality product, then that expense will be very high, much greater than that if you've got to do more make-readies, if you need to go make repairs to certain things in the property that were not done in recent years. And if you've got, say, $3,000 a year income, with one make-ready of replacing carpets and paint and replacing one hot water heater, you can have expenses greater than that ideal net income right away. So all of a sudden what looked like on paper to be very good is not very good. So we need to be very careful about what are the spoilers to the ideal income and expense. The prices of property in the future is very important to us. If we got two places to pick between, and one of them has a much better chance of being at a higher price later than another area, or a minimum chance of going down, that's the one we want. So we're going to look at prices here in a moment, as soon as we come back from a couple of messages, and we'll look at the different economic factors and the different price factors that affect where we pick a property. So come back with us in just a couple of minutes to KDOW 1220, the Wall Street Business Network.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back on KDOW 1220, where we're talking today about the how to select the best metro for investing. So, in addition to getting the maximum cash flow now, and by picking the right rent ratio, we want to know where are those rents and where is the price of that property going to be in the future. Because if we have two to pick from, we want the one that's going to have the least chance of going down and the maximum chance of being higher. Right now, none of those are more important than making sure it cash flows right now. But we sure would like to maintain that with time. You know, when we were going through the boom years, too many people were picking properties hoping that the price would keep going up, and they pretended that they were cash flowing, but they really didn't. And then they got caught when the, as Warren Buffett says, you can tell who's swimming naked when the tide goes out. So we all got affected by that, but we want to learn from it and move forward. So market direction indicators are what? Historical trends, what has happened in the past, helps us to judge where it's headed in the future. Affordability index, that tells us a lot about, that's one of the leading indicators of letting us know when prices are going to fall. Inward migration, that's a leading indication that tells us when prices are about to go back up. And negative equity. If you want to know right now where property is headed, one of the factors to look at is what percent of the properties in that neighborhood are upside down and by how much. If there's a lot of negative equity to clear out, there's a good chance it's not going to go up very much in the near future. In fact, it might go down more before it goes back up. If there's almost no negative equity, then maybe it's past bottom and it's on its way up at some rate. As you look at different states and different metros, you can see that historically some have gone up and down like a roller coaster and others have been more stable. Well, if you want to be speculative and go to one of those areas that's climbed fast, then just know that you're speculating, and still note that you, like Robert Kiyosaki teaches, that you still want to have assets that produce income today. You don't want to, it's very risky to go speculate on a property that you think is going to go up in the future and you're willing to put up with negative cash flow in the meantime. You can try that, but I don't recommend it. And you look at states like California and Florida, they've gone up and down a lot. Texas has, those major cities have been very much more stable. So if you look at, for example, what has happened to prices in the past, say since the peak in about 06 to when they hit bottom, you'd be amazed at how different it is from city to city. Las Vegas, for example, has gone down by almost 60% from its peak, whereas the better cities like Dallas have only gone down about 8%. Let's look at negative equity, another factor. You want to know how much negative equity there is in the city that you're looking at, and the state, and that varies a tremendous amount. Percent of negative equity can vary from one city of say 10% to another city of 65, 70%, and that's a tremendous amount. You also want to take a look more closely at how much inventory there is to have to go through before you've cleared out all of the negative equity. In a place like California, for example, with 8.6 million homes and 6.8 million mortgages, with 2.4 million underwater and 520,000 delinquent, we're only clearing out like 18,000 a month. So if you divide that into all those delinquent properties that are either in foreclosure or potentially about to go in foreclosure, you suddenly find you've got 42 months worth of inventory to clear out. So when we come back, we're going to talk about where the shadow inventory is, what percentage of owners repurchase, and other economic factors that affect the price. So stick with us and come right back on KDOW 1220, Wall Street Business Network.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to Real Estate 360 here on KDOW 1220. where we're talking today about how to pick the best metro for real estate investing. So we're talking about prices. We want to pick a metro that has a best chance of having prices higher and, more importantly, not lower later on with time, whatever length of time that investment is that you plan on. Many people, it's at least 5 years or longer. And let's look at, we've been talking about the delinquency and how that affects things. Well, as long as there's a lot of delinquency and a lot of upside down mortgages, it means that it's going to be a while before prices go up significantly. Personally, I think we've got a little bit of a bubble going on right now. And why is that? Because we have a very constrained supply of properties, which is not in a free market. It's being controlled by the banks at what rate they come out, so it has a very limited supply. We've got some pent-up demand. We've got some prior foreclosure people who now can buy a home again. So we have a pretty high demand relative to the supply, and things are going up. And that's good to a point, as long as we don't get ourselves into another bubble that needs some correction, which I think is quite possible. So yes, we still have a lot of negative properties, negative mortgages and houses to shed, but it is getting improved a little bit from the bottom as these prices go up. Did you know that only 33%, a third, of all the people who are losing a house or selling a house either are capable of or are interested in repurchasing a house? That's right, 1/3. This is nationwide as well as state. So the silver lining on that, the half-full glass perspective, is that there is a lot of opportunity for us investors if we can just get hold of those properties. Let's talk about employment. We've talked about prices and different factors that affect where the price is going to be in the future. And what affects that largely is employment. And what affects employment is, or population growth is employment. So let's talk about that. I like cities that have a broad base of economy. One of the problems with Silicon Valley, where I invested strictly for about 30 years, is that it's somewhat a singular economy. It's much broader than it was 43 years ago when I came here, because then it was mostly semiconductor. But today it's still high tech, and certainly high tech is very diverse, but it's not as broad as a place like Dallas, which almost exactly mirrors that of the United States as far as different economic sectors. You want to look at unemployment figures, and you'll find that varies a tremendous amount by state and by city. You want to look at short-term unemployment, and what are the net jobs? What are the cities that have the highest growth of net jobs? Right now it's Houston, Boston, and Dallas. And it varies with time, but you need to keep an eye on that. And that's what we want. We want jobs being generated that brings in population. That means we have increased demand relative to the supply, and that's what drives up prices and drives up rents. We like that. Look at how many Fortune 500 companies there are in different cities. And you'll see that varies. Out of the top 10 cities, it varies from 13 Fortune 500 companies to 28 Fortune 500 companies per city, except for New York, which has the leading amount of 70. That's good. And then you want to look at revenue. Dallas-Fort Worth, for example, my favorite city, the one I invest in the most, has the second highest Fortune 500 company revenue in the country. And that's a very positive thing that generates jobs and brings in the population. So ultimately, what we're trying to drive for are places that have more population coming in and at a faster rate than what the supply is, because that's what drives up rents and that's what drives up the prices with time. So, you can just go to the U.S. Census Bureau and get all kinds of data, and there's lots of organizations that boil that down for you, but you can go there and look at the different cities that you're interested in and see what the population growth has been over the past year, over the past decade, over the past several decades, and what you want. And of course, the past doesn't guarantee the future, but it usually has a pretty good indication. And you'll find that certain cities are growing at a much faster rate than others. In fact, there's some, like Detroit, that have been declining. And we we don't want to go in declining regions. Look at migration patterns. You know, a little trick that rule of thumb trick that's easy to use is go call up U-Haul and ask what the cost is to take a U-Haul from one city to another city, and then ask them how much it is coming back, and that tells you very quickly which direction they're going. Right, the direction people are going is going to be a high price, and the other direction coming back is going to be a low price, because in fact they probably have to pay drivers to bring those trucks back. Demographics. You want to go see what the demographics are in a region. What's the average household income? What's the immigration pattern? Where are people coming from? What's their what kind of consumer confidence they have? Look at what the ethnic makeup is of that city, and look at all those factors, and that can help tell you, guide you as to what direction it's going to go in the future. And then cost of living. You'll find that varies a tremendous amount by state. So if you have a low cost of living state or a low cost of living metro, that's an attraction. That's something that brings in the population. And it also brings in companies, right? So companies like to be in places that are business friendly. They like to be in places where there's affordable housing for their employees. They like to have local good schools, universities that produce future employees that they're going to need. Then we look at state government and see how stable it is. That may be an increasing factor as time goes on. You'll find some states like Texas are very financially stable, and in other states like California, as we all know, are struggling. It's bound to have some impact on whether or not businesses want to stay around and people want to stay around. And then lastly, we also always want to look at what the vacancy and rent trends are, and that tells us a lot about where things are headed. So we're going to take a quick break and do a little recap when we come back, and I'll give you Tom's top tip. So stick with us on KDOW 1220 Wall Street Business Network.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. You're listening to KDOW 1220, Wall Street Business Network. This is Tom Wilson, your host today for the Wednesday edition of Real Estate 360, and we're talking about the factors that affect how you pick the right metro to invest in. So we've talked about how it's very important to pick the right rent ratio, the highest that you can get. It should be at least 1% of rent relative to the purchase price. That it varies a lot by cities. You want to see what it is by cities. We're trying to attain the best income minus expense ratio that we can and find an area that has the least amount of spoiler of that income, so that you have the best vacancy and the least turnover, and that has the least amount of additional surprise expenses, which would be, again, areas that have good economic strength and that do not have maintenance issues and high make-ready costs. So those are all factors that are very important. If you'd like more information about that, or you want to review some of those notes and graphs we've talked about today, please go to TomWilsonProperties.com and look at the link there that has a PowerPoint with a lot of this information on there. If you have questions for me about this topic or any others, please feel free to give me a call at 408-867-1867, or again, you can go on TomWilsonProperties.com and put in an inquiry there, and I'll be glad to support you in any way that I can. 2 or 3 last points I want to sum up or leave you with. One is, be very careful about acquiring a raw property as opposed to a turnkey provider like Wilson Investment Properties is. The cost of taking a raw property to the point of cash flow is greater than most people realize. And another Tom's top tip for the day is don't go buy a property and invest in just because it's in an area that you want to go to. Many people say, well, I bought the property there because I like vacationing there. Or two, I bought the property over there in Louisville, Kentucky because I have a brother there and I like to go visit them. And that's just as wrong a reason as buying or getting into an investment that has great tax shelter but may not be a very good investment. Remember that your deduction of your trip to visit and go there is not very much compared to what you might lose by being in an investment in an area that is not as strong and not as good as it might have been. So I say go invest where the investment is best, and go vacation and visit where you want to vacation and visit, and don't try to mix the two, just like you shouldn't try to be a landlord as well as an investor. Just focus on what gives you the best return. So that's my suggestion about buying properties in your favorite vacation area. So it's been great chatting with you today about how to pick a metro. Again, go on TomWilsonProperties.com and look at the PowerPoint there. I also have a report that I can send you, a 19-page report that goes through this in more detail, and you can peruse the graphs and data at your convenience. And I think you'll get a lot from that. So it's been great being with you today.